Tortoise's Anthropic reportedly wants Wall Street to value it at nearly $2 trillion. To put that into perspective, that's about 42 times its current annualized run rate. And because revenue is growing this fast, the multiple on what they have actually earned over the past year is, as a matter of fact, much higher than that. Now, here is the thing that should stop you as an investor. The revenue number that would actually justify $2 trillion doesn't exist yet, because this is a forecast for 2028, a figure no AI company has ever reached on this kind of timeline. So the honest question today, Tortoises, is this the deal of a decade, or the clearest sign yet that AI valuations have completely detached from reality? This is what this video is about. So without further ado, let's jump right into it. Now, also important to notice, this video is not meant to be a rant. So I'm not planning, the goal is not to come here and start complaining about how crazy these valuations are and in how crazy people are for throwing billions of dollars at these companies that haven't yet proven their business models. But the goal is just to provide a realistic picture of where the company is right now, where it might be in the future, in whether the valuations actually make sense based on the growth that is being projected. And of course, ultimately, I want all my viewers to make sound investment decisions. Okay, so full disclosure. Of course, I don't have anything similar to Anthropic in the portfolio. I'm transparent about the companies in the portfolio. I don't have any of these shiny objects, and I completely think Anthropic is one of those shiny objects. But look, I want to give you my take on it, okay? So you guys can be fully informed. And without further ado, you can see right here that news about Anthropic's IPO are all over the place, which is why I have this page right here. So many things have been rolled out over the last few days, and I was reading a few of these articles. This was one: Anthropic IPO valuation nears 2 trillion, but will 200 billion forecast hold. So after reading all of this, I put together my thoughts into a Word document to provide you with a better flow. And to make sure that I cover everything that I want, okay? So let's talk about that. And the Word document is right here. So please stay with me as I give you my insights on this company and whether or not the valuation is completely out of whack with reality. So Anthropic wants Wall Street to accept a number that still sounds almost fictional: 190, 200 billion in annual revenue by 2028, which is only, it's less than 2 years away. So the figure bankers and prospective investors are already using to justify a price that would have sounded absurd, to put it lightly, 2 years ago. So the debate is not really about what Anthropic is worth today, it's a bet on what it might be worth 2 years from now. So what you will see, guys, is that this is the revenue forecasts. Okay, so the revenue forecast for 2028 is around 190, 200 billion. This is according to Anthropic, according to their Anthropic themselves. So according to their internal numbers. And that serves as the basis for the $2 trillion valuation. Now, what is the revenue run rate? In this, if you understand, this is something that I mentioned at the beginning of the video. What is the revenue run rate? So what happens with a lot of these companies that are growing very fast, so the way they do this is they look for the revenue run rate instead of the revenue, the core revenue, so the money that they've actually earned today. So how do you calculate the revenue run rate, and how did that jump from 9 billion at the end of 2025 to 47 billion by May 2026? So the revenue run rate gives you, so it's a snapshot of one of the months where the company made money. So let's take, for example, the month of June or the month of January, for example. Let's imagine that they made 3 billion in January. And then if they grew from one month to another month, that revenue growth, the run rate exploded like 100 or 200%. What they will do is they will take that number and they will then multiply it by the rest of the months. So in this case would be, for example, 12 months to project what the revenue will be, what the yearly revenue will be for the company. Okay, so it's just a snapshot of a month that they then multiply by 12 to give them the yearly revenue that the company might actually earn. All right, so hopefully this will make sense. And it's called the revenue run rate. It's not the core revenue, as all of you guys are aware. And so the quarter two 2026 revenue projected at about 10.9 billion, which is more than double the prior quarter. Let's talk about profitability. First quarterly operating profit forecast at about 559 million. Again, they are about to turn the corner to profitability, something that ChatGPT, for comparison, in OpenAI is definitely far from. Okay, but they are about to turn the corner to profitability. That's already a good sign. Valuation method. So the analysts have used 2 years forward enterprise value to revenue multiples. What does that mean? So it's not price to sales. So when you do the price to sales, you take into account the market capitalization of the business. So it's the value of the equity, which is the market capitalization. That's how you arrive at that numerator price, which you then divide by the number of outstanding shares, right? So it's price divided by sales. But they do enterprise value because that gives you the total value of the company. How you arrive at that, you do the market capitalization plus, market capitalization plus debt. So it's the total equity plus debt minus cash and cash equivalents. Okay. And the matter of fact is that comparable high growth names, like, for example, a Palantir or a SpaceX, they trade at 41.6 to 53 times expected revenue. So it's not completely detached from reality if we are going to compare it with these companies. But my understanding of this, guys, is that I never really understood the valuation that was assigned to any of these businesses. For example, SpaceX, which is a company that not that long ago just reported profitability of minus 5 billion. So they were actually losing money. And but anyway, that's a topic for another video. And I discussed that as well in a former video. Now, what is the bull case? A growth curve that bends the math. The core question is whether a company can quadruple revenue twice in little over 2 years, which is essentially what the 2028 forecast assumes. The trajectory so far gives the ambition weight a run rate near 47 billion by May 2026. Remember, once again, not revenue, but run rate. So it's based on their estimations. A run rate near 47 billion by May 2026, up from about 9 billion at the end of 25, roughly fivefold in under 5 months. This is incredible growth. By all means, this is absolutely staggering. And with quarter two 2026, revenue alone projected to at least double the prior quarter. We are seeing things that I think you would have to go back to 2000 for like in what was happening during the tech bubble, and to see stuff like this, like revenues growing at this pace by this much. This is incredible. That kind of curve is what lets bankers argue the 2028 number is extrapolation rather than fantasy. So how the 2 trillion is actually calculated, we've already touched upon that. Rather than pricing Anthropic on what it earns now, bankers are reportedly applying a 2 years forward enterprise value to revenue multiple. So you already understand the difference between the enterprise value to market capitalization and why they would use enterprise value, not least because it makes it sense for companies with different debt levels. So for analysts to compare them, because the enterprise value takes both equity and debt into account. If the company has different debt levels, then you want to use enterprise value. It's more accurate rather than market capitalization. Now, I want to be clear. Anthropic collected a lot of cash as well. So when you strip cash out, then of course the enterprise valuation of the company will decline. Valuing destination node, current mile marker. The same forward approach preceded the listings of Cerebras and SpaceX, where trailing revenue math looked almost irrelevant. Apply the comparable range, roughly 41 times to 53 times the expected revenue, to Anthropic's projected 2028 revenue, and the figures pushing toward 2 trillion start to look internally consistent. Even if they still demand a leap of faith, again, to put it mildly, about 2 years in between. So, what is the about something I want to talk about the profitability inflection? Let me just take a sip here. Tortoise cup again. For a company that has spent most of its life burning cash, a quarterly profit would be a genuine shift. Anthropic is reportedly forecasting its first quarterly operating profit at about, as I mentioned, 559 million. The caveat, the underlying cost structure remains a real constraint on how far that profitability can stretch. Because remember, they still are investing a lot of money. Heavy compute and infrastructure spending, unlike to ease soon. They are still in a growth stage, and so that spending is certainly poised to continue. So, what about the bear case? A valuation borrowed from the future, as I alluded to at the beginning of this video. The whole calculation that analysts are using, as I just told you, it leans again on tomorrow. Not today. It's not based on trailing 12 months figures, because that wouldn't make much sense for a company that is still at this stage in its business cycle. And so we are, of course, borrowing from the future. It assumes today's enthusiasm survives long enough to actually meet the revenue being priced in now. A heavy assumption when 200 billion in annual revenue has never been reached by any AI company on anything close to this timeline. Momentum can justify a number in the moment. Sustaining it requires the forecast to land. So right here, you can see, you are already understanding why I would never invest in something like this, because I'm aiming for doubles every 3 to 4 years, guys. And can you get a double with something like Anthropic? What do the probabilities say? At these valuations, my guess is that you are already buying into that growth that will materialize going forward. Because what happens is, if the growth doesn't materialize, if they end up with, say, a ridiculous valuation, but then revenues going forward fall well beyond, fell below expectations, you're going to see a significant multiple contraction, and you are going to get hurt massively. So I would say the odds are definitely stacked against you, not in your favor. And there are so many more opportunities in today's market, and you know them, especially if you have been following the channel for a while. So why would I risk my hard-earned money in something like Anthropic? I mean, it just doesn't make any sense to me. Cheap arrivals are already pressing on the economics that underpin these valuations, and the 2 year forward multiple is only ever as strong as the year it points towards. The real risk is whether market conditions, competitive pricing, and investor appetite stay aligned long enough for the forecast to become a durable stock price rather than a one-day headline. Why it matters beyond Anthropic. Pricing a company almost entirely on a forecast years out sets a template. This is another thing that I'm worried about, because other AI, look what happened. So SpaceX had its IPO, it was so hyped, and now that sets the tone for the rest of the IPOs that we will see going forward, in my humble opinion. So other AI labs preparing to go public will likely be measured the same way, for better or worse, which makes Anthropic's debut a test against for how public markets value the whole category. And in my opinion, this is a complete bubble. I think what we are witnessing today, guys, is one heck of a bubble. And if if they if some of these if the look, I'm pretty sure that AI is going to be a game changer. In fact, I can see that, and you can see that as well if you are using it when at work. I certainly use a lot of AI to help me dissect annual reports in conference calls, in analysts reports, and all of that. So it saves me a ton of time and money, granted. But I mean, do you think competition is not going to come in and steal market share away from them? So, and price is what you pay, value is what you get. I don't understand what's happening in this space. It's just I think it's fully priced for perfection. That's just my take. So what is the bottom line here? Look, can Anthropic quadruple its revenue twice in 2 years? I mean, can you believe that? Can they quadruple its revenue twice in 2 years and keep the conditions that make that growth possible intact long enough to be paid for it? If yes, then the $2 trillion is defensible on the destination math. If the forecast slips, or the enthusiasm, pricing power, or capital markets shift, the number was always borrowed from a future that didn't arrive. And I like to pay attention to trailing 12 months figures, guys. I know that the markets are always forward looking. That makes sense. And so a company that has, for example, a company that has a PE of around 15 times or 17 times today, that doesn't mean that it's cheap if the projections are dismal. If the company does not have like good growth projections going forward, right? So even if you pay even an apparently low PE today may turn out to be like a very costly mistake if the company then does not continue to grow, does not execute. And I don't want that. But this is completely it's a whole different level of optimism. And I like to stay away from things like that. I mentioned the same thing regarding SpaceX, and the company is still well off its all-time highs, even though it has recovered a bit. And so I want you guys to be fully informed and protected, at least any investment decision that you will be making as far as Anthropic is concerned. If you do go ahead with it, then at least you will be aware of the risks. For me, of course, this is not investing. It's more like speculation. It's paying full price for a future that hasn't shown up yet. And I'd rather own a great company at a great price than a maybe great company one day at a price that already assumes that miracle. And those are the shiny objects that I typically like to stay away from. And by the way, if a lot of the things that we discussed throughout this video sounded a bit confusing, don't worry, I completely get it, because I've been in your shoes, staring at metrics that make little sense to me and wondering if I'm the only one missing something. But that's precisely why I do these videos for our channel. And that's why I intend to continue to do them. And so if this resonates, and if you like thinking about the markets in pretty much the same way, calm, with the actual math backing up our arguments instead of hype, then you should probably know that I run a completely free WhatsApp group where I break down stories like this one and give insights into my investment process as things unfold. So it's pretty much the easiest way to follow along, and it's completely free. The link will be in the description, so you can join at absolutely no cost. I'll see you on the other side, Tortoise, and thank you so much for watching this video.